Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our tanker market update for March 2024. Well, now we're coming towards the end of the first quarter of the year, and it's been another strong quarter for spot tanker rates, albeit quite a volatile one, with quite strong rate movements over the quarter, particularly in the LR2 segment, as you can see from the rate chart here. And the strength in rates that we've seen in Q1 has been due to a couple of reasons. One, we've had quite strong underlying tanker market fundamentals, but we've also had a series of events that have influenced the tanker market and led to stronger ton-mile demand. So starting with the macro side of things, we have seen some improvements in the global economy in recent weeks and months. The rate of inflation seems to be easing at a faster rate than expected. And we've also seen an improvement in global manufacturing, which is particularly important for trade and therefore oil demand. And so as a result of these improvements, we've become more comfortable with the fact that we're going to see a soft landing for the global economy this year rather than a hard recession. And that's being reflected in more positive forecasts for the global economy and for oil demand. And as an example, we can look at the IEA's oil demand forecast for 2024. And back in October, they were only forecasting about 0.8 to 0.9 million barrels a day of oil demand growth this year. Whereas now in March, in their most recent report, they're forecasting about 1.35 million barrels per day. So they've increased their oil demand growth forecast for 2024 by about 50%. And now the IEA is more in line with the EIA, who are also forecasting about 1.3 to 1.4 million barrels per day of growth this year. And the EIA is forecasting about the same for next year as well. Should be noted that OPEC continues to be a lot more positive. They're forecasting over 2 million barrels a day of growth this year, so there is perhaps some upside as well to these oil demand growth forecasts. On the oil supply side, the main story over the last quarter has been OPEC Plus deciding to roll its production cuts forward another quarter into Q2. And at the same time, Russia has said that it will do some additional production and export cuts. However, this was largely expected, I think, and from Q2 onwards as well, we should start to see an acceleration in growth from non-OPEC plus countries, particularly in the Americas. So more supply coming out of the United States, Brazil, Guyana, and Canada as well. And a lot of that oil should move long haul over to Asia, so that should be have a positive impact on ton-mile demand as we go through the rest of the year. So the underlying oil supply and demand fundamentals still look pretty good, but really it's some of these near-term events that are having the biggest impact on the tanker market at the moment. I think we talked in our last video about what's happening in the Red Sea with the attacks on merchant shipping, and that unfortunately has continued over the past few weeks. And so now we're seeing fewer and fewer ship owners and operators willing to go through that region. And that's having a big impact on oil flows, particularly for ships that would typically go north through the Red Sea and the Suez Canal. So going from the Middle East and Asia into Europe. Instead, we're seeing ships having to take the long way around, going around the Cape of Good Hope, which is adding to ton miles and adding to shipping demand. And where we're seeing that particularly evident is in the LR2 sector, because I think for Europe, in terms of its diesel imports, there's not a lot of substitute for what it gets from the Middle East and India. So those ships are having to go the long way around, and that's creating a lot of demand and creating a lot of volatility on spot rates. What we've also seen in recent weeks is that Ukraine has stepped up its attacks on Russian energy infrastructure, particularly its refineries. And as much as 900,000 barrels per day of Russian refinery capacity is being impacted now as a result of these attacks. So again, in a market where the diesel side of things, the product supply side of things is pretty tight, Russia now is having to reduce its exports of refined product. So again, that's causing a bit of a scramble for product on the international markets and giving some support to product tanker demand. But it also means that Russia has potentially more crude available for export as well if their refineries are down. So I think we could see Russian crude exports being maintained. And again, with all of that oil, Russian oil moving long haul to India and China, and some operators not wanting to go through the Red Sea, then again, it should create a lot of ton-mile demand. And then the other factor that could be very positive for tankers in the coming weeks and months is the opening of the Trans Mountain pipeline expansion here in Vancouver. So that's a 590,000 barrel per day expansion of the pipeline, which is going to allow Canada to export more oil by sea out of Vancouver, with oil going to various destinations, US West Coast, perhaps to Asia as well. And because the port of Vancouver is restricted to Aframax size or smaller, this should really have a positive impact on Aframax demand from Q2 onwards. So that pipeline is being filled right now, and the expectation is that we'll start to see the first exports by the end of Q2. And once that pipeline is fully up and running, it could be as many as 30 to 35 Aframax cargoes per month. So when we take all of these factors together, the Red Sea disruption, the ongoing disruption with Russia, the pipeline expansion out of Vancouver, on top of the factors I already mentioned with more oil coming out of the Americas, and then we've still got Panama Canal disruptions as well. This all creates a lot of inefficiency in the supply chain, more complexity when it comes to seaborne trade routes, and that generally is positive for tonne-mile demand. And I think we're going to continue to see a lot of this disruption through 2024, which, coupled with the positive underlying oil market fundamentals, should ensure positive rates through the rest of this year and into 2025, albeit we'll probably continue to see quite high volatility. And just finishing up with what's happening on the fleet supply side of things, we have seen a bit of an increase in ordering in recent months. So last year we saw quite a bit of ordering on the Aframax and Suezmax side, and now we're starting to see some VLCC orders as well. So the order book is starting to creep up, but I think it's important to bear in mind that the order book is still relatively small in historical terms. So the entire tanker order book, when measured as a percentage of the fleet, is now about 8%, whereas the 20-year average is about 20%. So even though the orders have crept up, it's still a relatively small tanker order book. And more importantly, the size of the order book is still dwarfed by the fleet of older ships, which will have to exit in the coming years. So in the past 2 to 3 years, as ships have approached or exceeded age 20, we haven't seen many ships gone for recycling, because a lot of them have been absorbed into what we call the dark fleet or the shadow fleet, to service Russian and other illicit trading. But that shadow fleet is now kind of saturated. There isn't a lot of extra demand now for ships to service those trades. So increasingly, as ships reach and then go beyond age 20, and as the maintenance cost on those ships increases, it'll become harder and harder for those ships to trade on. And so we do therefore think that ship recycling will start to increase in the coming years. And so the number of ships that are being ordered right now, it's still not enough to meet replacement demand in the coming years. And for that reason, we think that tanker fleet growth will remain very low. We'll probably have negligible growth this year, and then for 2025 and 2026, we're forecasting about 1% fleet growth in each of those years. And the shipyards are now full for 2026 delivery by and large. So any new any new orders being placed now will be for 2027 delivery. So for the next 3 years, the order book is pretty much set, and we can have some confidence that fleet growth will remain very low. So again, combining all those factors, it's a positive outlook on the demand side. We've got a lot of disruption to trade patterns, and the fleet supply side continues to look very positive. And so we continue to have a very positive outlook on spot tanker rates for this year, but also for probably the next 3 years at least. So that's our tanker market update for March, and we'll speak to you again next month.